All right, another episode of Expandable. On the last episode, we just got done talking about like what a commercial loan should do for your business. If you're considering getting a commercial loan to buy a commercial building, what should a building do for your business in that process? You know, you want it to be an asset. You want to utilize it and optimize your business for growth. Yeah. So we talked about all those things. So if you are interested in that, go back and listen to that one. But now say, okay, yeah, I'm on board. I like all those ideas, and I think that that's what I should do. We're at a point where business is stable enough and growing that it's now time to invest in a bigger space for whatever reason, or for hopefully a lot of reasons. But should I do it now because interest rates are high? Or should I wait?
High to where they were a year ago.
Yeah,
but
should I
historically, they're not high.
Yeah, that's a great point. Let's start there.
So commercial rates now anywhere from 7s to say bad credit, very specialized property, say 7 to 12, percent. But at the end of the day,
that's on a 10-year.
A 5-year fix is typically a commercial loans 5-year fixed rate,
right?
And then again, you got to think let me backtrack because I do find, at large, they have a misconception of like ownership of banks. Mm-hmm. Banks aren't owned by the government. Right. When banks lose money, the banks are a business just like everybody else. Mm-hmm. Typically, rule of thumb is for, they have to have their own equity into it. So on commercial, it's not like residential that is backed by Fannie and Freddie Mac that you sell it, you made points for originating that loan. Commercial is staying on the books of the banks. Mm-hmm. So they just want that monthly payment coming in regularly, just like the terms of agreement. That's what they want. And when the bank loses, they're losing their equity, their earnings, their shareholders are the first ones to lose. Mm-hmm. Just want to get that out of the way. Yeah. And regardless of the rates, banks work on margins. To where a year ago, maybe overall deposits only cost 1% and they're lending out, for argument's sake, 5%, there's a 4-point spread. Right. Now, if the rates are 8%, well, their overall deposits may be 4% now, still 4-point spread. So the banks traditionally, like you think, the banks make more money in rising rates. Well, sometimes they do temporarily, and then everything catches up, deposits. Now they got the same margin, even though higher rates. So
that's great. Yeah, that's great for people to know. I mean,
it's not that, you think the banks are being greedy. No, their costs got up.
That's right.
So, but at the end of the day, in a commercial real estate, you've got one payment. You've got one payment. So built into that payment is going to be a portion of principal and interest. Mm-hmm. And that payment's going to increase based on either rate or the price of the property. So overall, you look at that dollar amount, does it make sense? Mm-hmm. If that doesn't make sense, then it doesn't matter if it's a 1% rate or 20% rate.
Right.
It's insignificant at the rate. Mm-hmm. But there is a benefit, a little bit to say a 7% rate, or 8% rate to a 3%. It does incentivize paying it down faster.
Right.
Now hear me out. Because if you saved and paid $1,000 on your payment and you're at 8%, well, that saved you $80 every year until that paid off and not paying that interest. Mm-hmm. So that extra $1,000 over the next 10 years saved you $800. Mm-hmm. At a 3%, it saved you $300 over that 10%. So there is kind of psychologically a good thing. So if you got that property at a less value, and what happens when rates go low? Price of real estate goes up because people say, I can afford $1,000 a month. Mm-hmm. Well, instinctively in your mind, it's like a car. When you go and buy a car, it hates so much the FFI&E. Well, how much monthly, how much payment can you afford a month? Yeah, that's what they're trying to get to, $500. Because then they're going to build in as much rate and as much points as possible to get to that $500.
That's right.
Now, I'm sure there's some ones out there that are more honest than that, but really,
I don't think
happens.
so.
Yeah, no. I've seen them.
Yeah.
The last time it happened when we bought a car, I saw it and I'm like, did you check this one? Oh.
Yeah, no.
Yeah. So, all in all, the real estate value had to come down too. So the rate sometimes, great. You got a better value on the real estate, and now you're incentivized to pay it down faster because it saves you more money in the long run.
Right.
So, I mean, it's a great thing. Really having low 2 and 3% rates or 4% commercial, I think it ends up doing worse in the long run. And if you look, I'm probably going to tangent, the value of individual houses in relationship to means income started really increasing high in the 70s per capita household. Why? It's because of the invention of the 30-year mortgage.
Yes.
Okay.
Right.
Are you kidding me? 30 years. And then, really, and look around in neighborhoods.
When it used to be 5 years or 10 years, maybe
5,
max.
10 years fixed, local. And then, we're going to come in here. We're going to help you consumers, and we're going to,
the American dream.
Yeah. So the government's going to, we're going to buy all these mortgage-backed securities, and we're going to develop these programs and fix it for 30 years. All it did was increase the value of the freaking houses throughout the nation. So now we're here, and the value of your house that you live in is so much higher than the annual income that it used to ever be. So did we have a great benefit of the rate?
Ultimately, no.
No, we didn't. We just changed the incentives, and you built in more. So, I mean, look at the cost of real estate. The cost of construction has really gone up, rise over the last years because of the rates being so low for such a long time.
Right.
So I think we probably deviated a little bit.
No, that was great. That was good.
Look at it. Is it time for that? Are you going to make more money? Are you going to save more money tonight on commercial, regardless of late? Now we're talking commercial. I'm not talking residential. It's another horse animal. You've got so much emotion and everything involved in residential.
Right. 100%. And your business is a living organism that hopefully produces cash that you can utilize as a tool against this asset.
Yes.
Which I think is kind of goes to this idea of rates. Like if the rates are high, even if you didn't know everything you just said and just took it at face value, well, I'm spending more. Yes. But is your business growing, and do you need to feed that business so it can continue growing at a pace that's higher than that cost increase of the rate?
Yeah. And another tax.
And if so, you need to.
Well, and there's a little bit of tax advantages too. Perhaps I'm not a tax accountant or anything else, but that interest you can write off, that's an expenditure. Reducing that principal doesn't, that's a savings where you get the benefit when you ultimately sell, or you're paying less interest on that principal.
Yeah.
But in general, that more of that payment doesn't make. So if you paid more for your property and less on interest, you're still going to pay it off at the same time if you've got a 20-year amortization, but at least during that time, you get the expense, all the interest in the meantime.
Yeah, that's right.
So there is a savings on that business side. Interest rates are up.
Yeah.
At least you get to expense that.
Well, and also in 5 years, you can refinance when the rates are lower.
Yeah, you can look at it at that time. It may cost you, 2 to 5% on the overall amount when you factor in appraisals, and if you need to get a new survey, new whatever.
If you've made improvements, the appraisal price, the value is going to go up. So.
And the other benefit, insurance historically should be less when rates are higher because of the value of the properties to decrease. That's less value that you have to insure.
Sure. Yeah. All really good points. I think there's some really good pros and cons in there for businesses to think about as they're going down this path. I'm just of the mindset that if your business is growing, keep putting fuel on the fire. You're gonna make out 2, 3, 10-fold more than getting stalled by a high rate. And the high rate's not the end, as you've just mentioned. There's so many other factors. It's not the only factor.
One of my favorite years in financing was in 2009 and 2010, because you had that build up prior to 2008 where just prices were getting so high. And rates, commercial rates, I remember back at that time, 9 and 10, they went up higher, just like the Fed increased Fed rates then, and or they hadn't gone down yet. I can't remember which, but we were closing on loans anywhere from, say, 6.5% to 8.5%.
Yeah.
But 2 years prior, those commercial properties were 20% higher. And so what was amazing when, we came in lending, they're like, 7% is high. It was 5% 2 years ago. Look at them, I go, do you realize the property you're buying today is 20% less than it was 2 years ago? What would you rather do? And they were like, okay, you're right. So on $1 million property, $200,000.
Right.
But yet they were concerned with 2% a year that at least they can pay down.
That's right.
And not have to pay that extra.
Right.
So just that 2%. I will take that higher rate and 20% less property value all day long.
That's right. Yep. Love it. I think that answers the question. Should you buy a building to expand while rates are high? It's not a definitive yes, because every situation is different, but there's a lot of really good pros in there.
Two other pros I can think of.
Yeah.
What happens if you're not sustainable, that you can't afford that payment, and then you go to your lender and say, Ryan, here's our business. Here's where we're at. I can't afford to pay $1,000 a month.
Right. And
let's say you're at a 8% interest. I'm doing everything I can. And you look at it and you're like, okay, we can't pay that 1,000, but I can pay 900, 800. And temporarily, if that lender had to reduce that rate, okay, they can reduce it from 8 to 6 to 5 or 4. Lenders, I mean, you'd rather, if you've got that.
You have to show hardship.
Yeah, you've got that person in there, but they're doing everything they can. They've got good character. They're not lying to you. Much better to reduce that rate than you are to foreclose.
Yeah.
So where are you going to go on a 3 and 4% loan? If you can't make that payment on 4% loan, what's the difference in a 1 and 2%?
That's a great point.
Very little. You've got no room. And you know what? If it's 3 or 4% and now rates are higher, guarantee your property value devalued. So at least then you're buying at a higher rate, things get better. Typically you're going to have increase in property value too.
Yeah. Great points.
Yeah.
All right. Well, I think we dove into that one pretty good. There's a lot of good education for buyers that, hearing that from a banker is very important.
And I haven't heard too many people or even bankers talk about that. And especially what I really hate out there is, well, when you've got like mortgage brokers out there, when they just want to say something rosy every single time. Rates are so low, come refinance. Okay. Yeah. Don't take money that you don't need. That's what they're telling you. Yeah. So everybody over the last few years that took out 30-year idle loans at 3.75, I bet you, I don't know. I bet you 95% of them already spent that money when they didn't do, because it was so cheap. And now where does that get them now? Yeah. You know? Yeah. I mean, the moral of this story to me is being able to think for yourself in the situation and be able to discern a good financial move that makes sense for you and your business, without being swayed by the normal markers that are out there, which are rate, value, market going up, going down. You're running a business. You need tools to run your business. A building is a great asset to help you run your business. Now you have to look at the financial side of the building because you have to. And if it's 8, 12, 3, it factors in for sure, but it's one factor. Yes. There's a lot of other factors that need to be factored in for it to not be a good deal. It shouldn't be the factor that you make your decision on. No. And if it's 1 or 2% that is making it unaffordable, then maybe you're stretching yourself way too thin. Should think about it. Yeah.